Hello, everyone, and welcome to our 2022 Livestock Outlook. My name is Pedro Schicchi, and for those who were in our previous session, you already saw me there. I'm a market intel analyst here at HedgePoint Global Markets, and I cover livestock, but I also cover grains and oilseeds. I'll be joined here today by our Senior Relationship Manager and long-timer in this market, Ryan Hoyt. Quick disclaimer, and introduction is done. Let's get started. As you guys can see, these are the topics that we will be covering, and spoilers ahead. China, US, and Brazil will be our main focus here today. I'll take you guys into the US and Brazil section, and then Ryan will take over. But first, let's talk a little bit about the why that we are doing all of this. So, in this first part of the presentation, we'll be trying to answer the following three questions. One, how much the world will demand of meats? Two, of this total demand, how much will need to come from overseas, and who will be supplying it? And on this point, we'll be mostly focusing on how much of this trade flow that we are estimating will originate itself in US and Brazil. And finally, given the internal and foreign demand, how much will Brazil and US need to produce? And to answer these questions, this is the framework that we will be applying over and over again. For countries that import meat, we will first assess their domestic demand based on macroeconomic variables. Then we will estimate how much of this demand they are able to produce for themselves. And lastly, we will estimate how much they will need to import from elsewhere given the difference between these two. For exporters, we will estimate the domestic demand the same way as before. The exports are based on total world's import demand, so aggregate of all these import demands, and the historical share of each country in each type of protein. And the sum of these two give us how much these countries will need to produce. Okay, so before we start diving any further, let's take a look at who are the big players in this market. On the importer side, there's a very clear concentration on Asia. China leads the list with almost triple the imports of the next country in line, which is Japan. On the exporter side, US and Brazil lead the way with the additional feature of being the only two to export all the main three kinds of protein, which are pork, beef, and chicken. So right out of the bat, it becomes very clear why we are having these three countries in our agenda. Okay, so when we take a look at yearly aggregate numbers, the animal protein market is very well behaved. It had all but grown at a pretty steady pace all throughout the last 2 decades with only small disruptions. But then came the African swine fever. It was a disease that started in 2018 and decimated a good portion of the pigs herd in China. And different from the Americas, pork is the preferred protein in China. So suddenly China didn't have enough meat to feed the largest population in the world, and it had to start importing. As you guys can see, this had a massive impact on the world's steady progression. Especially exporters benefited from this factor. But now production is starting to recover once more, and even though it is not at the same level as it would have been prior to the ASF, the questions now become, how will the exporters adapt to this recovery? Will it go back to the same as it was before? And how long until we reach a new equilibrium? So at a global scale, ASF pretty much continues to be our main topic, even after 4 years, only now from a different perspective, from the perspective of recovery. Well, as I said, exporters benefited a lot from the ASF outburst in China. Brazil collected the benefits earlier as US was still undergoing the trade war with China, but the current scenario is the same for both countries. Their current export level relies heavily on the big demand coming from China. And the problem is, as China recovers its production, their import demand will not maintain the same level, therefore creating a risk for these levels of exports in US and Brazil. Here we see more clearly the ASF impacts on China alone. The pork production fell from representing close to 65% of total demand to something closer to 50%. And therefore imports had to increase to offset these loss of supply. In 2021, this measure already surged back to close to 60%, which is a significant rebound. But the first thing that we have to concern ourselves is what is likely to happen in China in these next 2 years. So let's get right to it. One thing is a fact. Per capita demand for meats, for total meats in China had already stabilized at around 60 kilos per or 130 pounds per person a year, even before the ASF. During the brunt of the shock, this indicator obviously fell. However, as we move past it, it is expected to return to the same levels. In turn, the total demand in China will go back to increasing at the steady pace as it was before the ASF. That is, if no further disruptions take place. However, there's one interesting fact to highlight here. As the ASF impacts were mostly on pig production, on pork production, the Chinese were forced to other kinds of meats, to other types of meats to supply their demand. As we leave ASF behind, we do not expect all of this demand that migrated to beef, for example, to go back to pork, even with production back to quote unquote normal. So we do expect some change in cultural behavior here. The return to normality was and still is, in fact, our base case scenario. And this is due to the fact that the hogs herd is at a 7-year high on China, enabling the slaughter pace to resume a much higher rate. And the herd here is the gray area. However, the herd has grown to a point of oversupply of the market, mostly led by the excellent margins that the pig producers in China were seeing throughout the past couple of years. In turn, when this finally translated into high slaughter rates, the pork prices collapsed and it brought the margins for pig producers with them. In the short term, this oversupplied market further decreases the Chinese appetite for imports. However, in the mid to long term, if this scenario persists, we are likely to see the market adjusting to a smaller herd and to a smaller slaughter rate to find its new equilibrium. But a caveat here, as the investments in rebuilding the herd were considerable, it might be some time before we see the margins affecting the herd numbers. And as such, the pork production pace might only slow down towards the end of the year. Again, if the scenario persists. So, demand is expected to grow, but so does production, especially with the slaughter pace that we have been seeing. As such, our expectation is that China will need less and less imports from now on. However, there are some subtleties to this forecast that we need to go through. First, we recall that part of the demand that migrated to beef won't go back to pork. And as China does not produce a whole lot of beef, their import demand will be more resilient. Pork imports, on the other hand, tend to lose the most in this scenario. Second, the whole picture with the margins declining that we gone through in the last slides could threaten this production forecast. However, again, it takes time to reverse, even if only partially, the big effort that was made to rebuild the herd. And on top of that, Chinese government has already declared that it will intervene in the market. It will buy pork to maintain prices in a range that is profitable to producers, but doesn't hurt consumers as well. So we cannot expect pork margins as excellent as they were during 2019 and 2020, but they might be maintained in positive territory at least. So with that, we wrap China, and now we move to the Americas to see how this whole scenario will affect the S&D over here. So the later months of 2021 and early 2022 for that matter already show how the new level of production in China is affecting our side of the globe. US and Brazilian exports of meat to China specifically declined significantly, removing a key support to total demand. Brazil was especially affected as the lower Chinese demand coincided with the mad cow cases, which restricted the exports of Brazilian beef to China. In the rest of the globe, import demand is expected mostly stable or slightly declining, with the exception of chicken. Being the cheapest of the three kinds of meat, this could be attributed to the poor economic scenario that the world is experiencing in the aftermath of the pandemic. Now, combining both of the previous forecasts, so import demand in China combined with rest of the world import demand, we have the expected export demand for both US and Brazil. And the trend here is clear: declining exports, especially of pork. Beef is likely to be a bit more resilient on account of the factors that we mentioned previously for China. Much like in China, both US and Brazil have very stable per capita consumptions of meat yearly. In turn, the domestic demand grows mostly with population and does not have a whole lot of volatility. That is, if there's no production shocks, no limit imposed by the supply side of the balance. It is mostly on the demand side specifically, it is mostly the exports that add that extra spice, that extra volatility to the numbers. So finally, we circle back to production. And here we see more clearly how China affects each of the two countries differently. In Brazil, exports represent a higher share of total demand. As they are expected to decrease going forward, this is more clearly seen in the expected level of production, which also declines in 2022. In the US, on the other hand, the domestic demand is much more dominant. And as such, the populational growth is still likely to offset the loss in exports, even if there's not as much demand coming from foreign markets as before. Okay, so far what we have done is dissected the micro forces at play here at the global meat market. However, it is not as simple as that. There are a whole bunch of internal dynamics at play in every country that determine how these forces that we have been talking about affect the market. And it is to discuss precisely that with a focus on the US that I would like to call our expert Ryan to continue this debate. Please, Ryan, take it over.
Thanks, Pedro. My name is Ryan Hoyt. I'm a relationship manager and the livestock specialist on the US team. And we're going to focus on the US livestock markets and a number of risk factors. First, we want to continue this focus on China and what the changing trade situation might mean for US markets and producers. From there, we'll pivot and consider a range of domestic topics and their implications. Overall, though, we want to stick to a theme of volatility rather than bullishness or bearishness, as each of these different scenarios can play out in a number of plausible directions and are currently and will continue to lend great uncertainty to the market. In recent years, we've seen total exports as well as production grow for both pork and beef due to a combination of the outbreak of ASF in China, as well as the negotiated phase 1 trade deal. We've seen significant changes in our relationship with China. Exports to China across both pork and beef have seen fantastic growth, and this has helped to support the U.S. livestock sector and the protein markets. As we saw earlier, beef exports to China have grown throughout 2020 and 2021. But since 2019, pork has been the greater beneficiary. At one point, we were sending roughly a third of total U.S. exports across the Pacific. Pork exports to China have had significant impacts, but have also been very volatile since the outbreak of ASF. Initially, the U.S. market saw large China-bound sales in the first half of 2019. This caused the lean hog market prices to surge. It pushed the summer contracts well into the 100s during the spring of that year. Shipments themselves would take some time, as you can see on the chart, to ramp up, really kind of hitting their highs into 2020. But the optimism would function to support market prices throughout most of the year. Unfortunately, though, this optimism was disrupted in 2020 by COVID. And because of COVID, we experienced distortions in consumer spending, disruptions to animal processing, This obscured the effects of our strengthening exports. It shifted the focus to a highly volatile domestic market and inconsistent processing industry. With the exception of the labor difficulties, which we'll get to, we've largely seen COVID-related problems in the protein sectors, specifically the backed-up animals, recede throughout 2021. It's allowed the market to shift focus back to exports and other positive fundamentals. After 2020, we saw the pork market and Chinese exports become closely related again, with prices and shipments climbing together into the summer and then receding together into the winter. Overall, pre-ASF and trade deal, total U.S. shipments of beef and pork combined rather consistently to total about 30,000 metric tons per week. Mexico, South Korea, and Japan were all consistent and dependable markets for U.S. exports. But this 30,000 ton total began to climb in 2019, as you can see on the chart here. It hit new highs in 2021. Nearly 50,000 metric tons weekly were leaving the U.S. That's more than 50% over historical levels. Overall, total exports have receded some since last summer and are now sitting at a rather consistent 40,000 metric tons weekly. This is still a spectacular rate relative to historical levels. It's not something to be taken for granted, especially in light of the pandemic-induced supply chain difficulties that we're all well aware of. These totals could potentially climb back to the mid-2021 levels that we saw, the 50,000 ton type numbers, on renewed demand, or if we're able to smooth out some of our international logistics difficulties. Between the recovery of the Chinese hog herd and these supply chain issues, there is the equal risk that we could see these exports fall back further. Chinese hog production margins have returned to pre-ASF break-even levels recently. Herd numbers, slaughter numbers have fully rebounded, with domestic headcount even larger than the couple of years before the virus broke out. Suppressing domestic pork prices and correspondingly demand for expensive premium imported meats. This isn't to say ASF is gone, but that the Chinese industry seems to have outgrown it. At this point, there's great uncertainty with what this means for the markets. A recovery in Chinese margins would help to price in U.S. meat and can certainly add bullishness to the board, while a continued tepid export situation will leave the U.S. market dependent on other destinations and on domestic consumption. From here, we're going to shift away from China and look a little more closely at the U.S. domestic situation. First off, the policy front will pose both bullish and bearish risks to the livestock industry and to market prices. We see here several headlines from Reuters, IHS Markit, Bloomberg, Times, all showing topics that could have significant impact on the livestock sector, on meat prices, on hogs and cattle prices throughout 2022. Inflation and logistics difficulties have recently caught the attention of policymakers at all levels of government. And as such, we should probably move through 2022 expecting a wide range of government interventions to address these issues. Of course, some of these interventions will be more effective than others, and some will distort markets more than others. A little more close to us, Proposition 12 has seen significant attention in the U.S., especially on the pork and poultry sides of the market. And while it's been delayed, or certain aspects of it have, it will see the implementation of regulations regarding animal husbandry practices for meat sold into California that will impact the whole industry at some point here in 2022. Recently, we've seen a resurrection of trade deal tensions revolving around a perceived failure of China to fulfill its phase one obligations. And in that same vein, though it hasn't gotten as much attention in the headlines, we've seen a slew of WTO rulings against Trump-era tariffs. For example, most recently against tariffs on South Korean washing machines, for example. On top of this, congressional attention has recently fallen on the packing industry regarding industry practices and perceived outsized margins that packers have benefited from at the expense of the independent producers and the American consumer. All of these issues carry the potential to see government and regulatory intervention leading to uncertainty in market price and industry reaction. Meat prices have been wildly volatile now for the last few years. Beef price, in particular, has climbed significantly above its historical relationships with chicken and pork. You can see this in both graphs, really. Beef prices outright, on the left there, are up nearly a third versus where they sat from 15 to 2019. And pork is back to levels last seen in 2014, about 20 to 25% above that same period. Chicken, on the other hand, is up only marginally since the beginning of the pandemic. On the right, you can see that beef is inflated from a relative perspective against both chicken and pork, which might argue, again, all things held constant, that of all the proteins, beef would be the most likely to see a drop off in price. Though arguing from a historical perspective, especially over the last couple of years, has certainly been a very risky proposition. And any labor or logistical changes could very quickly prove us wrong. As such, despite, or maybe because of their historically elevated levels, meat prices will continue to be a major source of uncertainty and volatility for the larger livestock industry. Cold storage, we see here, sits below recent norms, providing little backstop against any sort of fluctuation in demand. Pork is sitting at multi-year lows, especially for labor-intensive cuts like processed hams, which we'll see next. Beef has seen declines, though these have been seasonally influenced more than anything, it seems. And chicken has declined as well, but from what were actually relatively high levels recently. Taking a look at the hams, while below 2016 to 2019 levels, bone-in hams have remained at or above year-ago levels. At the same time, we've seen boneless hams decline to well below year-ago levels and remain there. This alludes to not just a lack of reserves for cuts, as you can see in the graphs, but the larger labor issues impacting the economy. Basically, processors have been unable to secure the workers needed to consistently conduct the value add process, turning bone-in hams into boneless hams, in a satisfactory way to meet demand. The labor shortage is even more apparent at the animal processing level. Cattle, for example, didn't see the first 120,000 head harvest day of 2022 until the end of January, and they remain below year-ago levels. Poultry harvests, again, also below year-ago levels, and even at times below the 5-year lows. Hog processing overall has probably seen the biggest struggles, averaging about 10% below year-ago, running towards the bottom end of the 5-year range during the latter half of 2021, and now threatening to set new lows with very little relief in sight. This has functioned to make animal harvest and meat output inconsistent, and it's lent incredible volatility to the daily meat and cash animal markets, and thus to producers' bottom line. After the disruptions caused by COVID to animal processing, we saw both hog and cattle inventories jump during the 2020 timeframe. For the most part now, though, hog and cattle inventories are down. They're at similar levels to 2019, actually. You see this on both charts. As we move out of the COVID-defined world, and hopefully at some point in 2022 see processing rates return to past levels, we could potentially add to this lower inventory some strong demand for cash animals in supporting producer margins along the way. But as we saw in prior slides, we continue to struggle with depleted slaughter rates. The benefit of decreased inventories on prices received by producers could be pretty mitigated. Particular to cattle, 2021 has been a year of expanding drought in the western states. While the intensity of the drought in the Southwest, as you can see here, has lessened somewhat, the overall acreage in drought continues to expand. This has led to increase in aggressive placements in cow harvest and will continue to do so unless we see the forecast improve. If the drought continues or even worsens, we'll need to be aware of the potential price appreciation and volatility that may follow in the cattle markets, especially in the latter half of 2022 and moving into 2023. High-priced grains, though, could function to weigh on this market, though the drought isn't necessarily, as you can see here, as severe in the main corn-producing regions, Iowa, Illinois, Minnesota, as it is in the West. Zooming out kind of to the macro side, inflation has been a major headline moving into 2022. This has largely been driven by policy and supply chain issues. The consumer has seen greater inflation in recent months than they have in at least the last decade. And once things like this start, inflation has a habit of becoming a monster of its own. The expectation of inflation adds to inflation. It causes people to spend money now. It causes prices to increase, and it leads to greater inflation. Food prices have been a big part of this updraft, at times greatly exceeding the core numbers, as you can see in the graph here. This can be a benefit to livestock producers, certainly, as it functions to encourage processing throughput and support wholesale meat prices. But with high inflation taking a toll across the consumer budget, and many of the government's direct payment and household subsidy programs coming to an end, we need to keep a watchful eye on meat prices, even as we remain optimistic about their prospects in 2022. For comparison, the volatility and appreciation of energy prices have exceeded just about anything else in the market. At this time last year, many consumers were paying less than $2 per gallon at the pump in the US, while many are now paying upwards of $4 or $5. And we point this out because this can be a headwind for things like food expenditure that need to fight for space in the household budget. It's something to be aware of. With that in mind, we put together a 30-day volatility chart on wholesale meat prices to show just how erratic and volatile these markets have been. The daily volatility on beef and pork prices at certain times in the past, late 2017, for example, beef being a stark example, have seen short-term surges. 2019 with ASF and massive initial Chinese export orders, we saw another surge, this time in pork price volatility. But both proteins together saw major jumps in 2020 due to the inconsistency of throughput, changes to consumer purchasing patterns, but only really beef returned to historical levels, as you can see here. Pork price volatility remarkably climbed even higher in 2021 and now even more aggressively into 2022. This is adding great uncertainty to lean hog market prices and to producer margins. And on the topic of margins, overall, they've been variable and volatile. This is a measure of hog producer profitability made available by Iowa State University. Hog producers in recent years have been profitable, especially in 2021, and that does look to continue into 2022, as indicated by current market prices in the hundreds. At the same time, as we've shown earlier, underlying market factors and daily pricing mechanisms have been remarkably volatile, and these opportunities for positive returns should be seized on by producers. On the cattle side, margins have been less friendly, according to Iowa State. And as producers have experienced a string of negative margins recently there, they'll want to be proactive in seizing their opportunities for positive returns and in managing their inputs. From here, we want to move on to our conclusions. Our key takeaways. China currently shows minimal signs of intending to return to its export highs on pork, though it has been relatively steady on beef. Without this market, the U.S. pork industry will need to look to other destinations and domestic consumption in particular to support itself. The drought spreading from the western states has significant potential to disrupt the U.S. cattle markets, especially as we move into the latter half of 2022. Policy actions to address inflation, rising consumer costs, processing margins, and other topics will impact the livestock industry this year, adding another layer of unpredictability to our markets. Overall, volatility will be the theme of 2022 and will require proactive and well thought out risk management practices from industry participants. So thank you all for joining us. We will now be opening to questions.
Okay, guys, we hope you all find what we have shared so far to be of use, to be of your interests. And now we are opening for questions for our Q&A. So let me stop sharing my screen. Let me see what we got here so far. Ryan, I think this one is for you. If margins for Chinese hogs are negative, what does that mean that ASF is now gone?
No, what you've seen is a massive round of consolidation in the Chinese industry, really since August of 2018 when it first broke, and those high margins that you saw for the last couple of years allowed the very large producers to grow bigger, to build more efficient, better kind of biosecure facilities, and you've seen the the small backyard farmer kind of disappear. They've simply seemed to have outgrown it. At the same time, too, you also have to look beyond China. You have Haiti and the Dominican Republic both have ASF. You have wild pigs across Europe. You've seen now cases in Italy and in Central Europe. So the threat of ASF is absolutely still there. It's just the economic realities in China have, in a number of ways, recovered.
Yeah, awesome. And also, if I can add my 2 cents there, the last I saw, there was a resurgence in China, but it wasn't as big as it was back in 2018, 19. So it definitely has it's not gone, but also is not at the same level as it once were. And also it relates to that you just said. The industry is much more consolidated now, right? Okay, so next one. Do you think the conflict in Ukraine will have further effects on the protein trade?
Potentially, absolutely. Staying in the ASF vein, I'd certainly be concerned about any boots on the ground situation in Eastern Europe. Beyond that, there's really the risk that in conflict like this, you can see it spread. You can see it snowball to other regions. If for any reason you see any involvement of China or another anything in Southeast Asia, you'd really have some serious concerns about exports into the Pacific. Russia itself is pretty self-sufficient from what it produces, so you're not too worried about them not importing U.S. meat or something from the West. But a conflict like this is very confusing, and you could really see snowballing, other parties get involved that could put global supply chains at serious risk. As far as specific and direct effects at this point, I think we very much have to stay in a cautious wait and see mode and be prepared to protect ourselves from those risks.
Yeah, interesting. That's a recurring theme, right? Protect yourself. Maybe we don't have, maybe we don't know what is going to happen, but protecting yourself is always a good idea in this high volatility markets, right? So next one, are there other growth markets for protein exports out of US and Brazil? Ryan, I think you should take this one also.
Yeah, I mean, you've seen fantastic growth in Mexico on the pork side in recent months. I think with kind of the difficulties with shipping things overseas, our ability to truck meat into Mexico has been a huge benefit to beef and pork, as well as, like on the pork side, you've seen Colombia grow the last few years. Latin America, Central America are certainly going to be growth areas. Beef, Southeast Asia, South Korea took quite a bit of beef last year. China honestly still looks very positive, all things considered. There's no opportunity right now that's like a China 2020, 2021 as far as pork and beef goes. China, there is only one China. Further down the road, there's been lots of talk of looking at it as like Western African business expands. There's a lot of poultry that goes in there. Those are kind of the markets of the future further away. But really, we're probably going to have to see these protein markets rely on growing lots of smaller markets, especially if this China business, on the pork side, doesn't come back in 2022.
Awesome. So we have a next question here. What's the difference between USDA and OECD data and why it's need to be adjusted? So I think I can take this one. So the difference is that they take different things into account. For example, OECD actually considers all poultry meat consumption in their data, while USDA considers only chicken, or at least in the data series that we got. So this is why we have to adjust them in order to compare them in the same base. I think next one here, how likely are the Brazil beef exports to get back to the levels that they were at 2021 before the mad cow cases? Okay, so I can take this one also. What we have seen actually is Brazilian exports of beef spike back up in January, just as the Chinese restrictions on Brazilian imports were lifted, we saw beef exports rise back up, and this relates to what we said in the presentation, that beef exports are more likely to be resilient than pork, for example, which is the exact kind of protein that Chinese production is recovering on. So beef exports are a bit more resilient, and now that this problem has been lifted, we are seeing this exports back up. It's not at the same at the record high levels it once were, but not at all as bad as it was in these last few months of mad cow cases. So, last one. What are the threats to domestic consumption in U.S. and Brazil? Ryan, I think this one's for you also.
I mean, we talked about a number of things. You know, I really would emphasize inflation being one of them. You know, mentioned earlier, last year at this time, you know, the U.S. consumer, for example, is paying under $2 a gallon at the pump for gas. Now you have a lot of places paying $4 and $5. We have to be very conscious of how, you know, the end of these government subsidy programs and inflation eat into the household budget. You know, when it comes to sustaining high-priced proteins, historically high-priced proteins. Within that household budget. The one thing I didn't really talk about earlier too, as far as the implications, because it really depends on how the situation develops, you're seeing more avian influenza cases. You know, you've seen them in Indiana. I believe there was just a case in Delaware as well. You want to see how the world reacts to that. In 2015, we had some export bans that forced more turkey onto the market. That could potentially, especially, you know, with the high price of beef and pork relative to chicken, if you have serious export difficulties and you see meat coming onto the market, it could function to depress kind of prices across the board. That's really, I think, the biggest issue domestically that we didn't talk about earlier, and will really be something to watch as it kind of develops here, moving into spring and as, you know, bird migrations and that take place back north. But otherwise, you know, inflation, now the geopolitical risks we're highly attuned to, herd health, things like that, the drought, all those things we've talked about, we have to stay conscious of. But I would also add in the bird flu situation.
Okay, thank you very much, Ryan. I think this is all we have time for today. We thank everyone that participated on this webinar series. We are finishing it off. This is the third day. Feel free, if you haven't had your question answered, feel free to use the QR code and send and share your questions with us. Ryan, if you have any last words, please feel free.
No, I think that was well stated. We look forward to hearing and working more with you guys as we move forward.
Thanks, guys. See you next time.